So let's talk about Jerome Powell, because he's made very clear that he would like to cut rates. The data so far hasn't been quite cooperating with that impulse, but maybe a little bit of weakness in the last couple prints. Where do you think he stands right now?
Well, I think for him today, the reality is that we still have 3 inflation prints before the 18th of September FOMC meeting. So that means that he doesn't need to come out with a strong view in either direction. It's pretty clear that they will not cut in July. And it is quite fascinating how the market always says, oh, it's not this meeting, but the next meeting is when the cut will come. So I still think we have some time here for at least 2 or 3 more inflation prints before we find out if the Fed has enough confidence in inflation actually moving down towards 2%.
Why do you think no cut in July? Peter Cheer of Academy Securities was on earlier, and he said he thinks it'll be in July. It's the last day of July, right? Because the Fed doesn't want to cut too close to the election.
Well, I think there's a number of challenges with that view. Namely, first of all, if you look at the weekly Redbook retail sales data, is still very strong. If you look at auto sales, monthly data, also very strong. If you look at some of the numbers that have been coming in across the board on CapEx spending, on AI spending, on AI earnings, and when it comes to the value of stocks going up, the tailwind to the economy from easy financial conditions is also very strong. So I think that for the Fed, the issue is they need to get inflation to come down towards 2%. And we'll see on Thursday what we get on CPI. But the question is whether they will have that confidence at the end of July. And I still think it's questionable. If this is the case, they definitely need to change their communication sooner rather than later.
If I type ECSU on the Bloomberg terminal, I see economic surprises, and they're all to the downside. And I read your notes every day. You've mentioned commercial real estate recently and the fact that vacancy rates continue to remain high. I was talking about this with Lori Calvasina. And there's a maturity wall coming due. You know, isn't the Fed worried about tripping us into a recession?
I think they are, but from their chairs, they will probably say, well, we need to raise interest rates to make it more difficult to get financing for consumers and for firms and in commercial real estate. And if you look at the progress of this process of the Fed having raised rates since March of 2022, we're just still not quite there yet. If you look at the employment report last Friday, for the last 3 months, employment growth has been 200,000. For the last 6 months, 200,000. For the last 12 months, 200,000. Yes, the unemployment rate is going up, but a very important reason why the unemployment rate is going up is not because people are getting fired. It's because more people are showing up at the labor force, most likely immigrants and others, that are basically saying, well, we would like to have a job. That's a good sign of the economy actually doing reasonably well. So I still think that overall, yes, that process of destroying demand as a result of rates going up is playing out in certain parts of the economy, including commercial real estate. But when you look at the aggregate impact with 206,000 jobs created in the month of June, that's still an economy that's doing quite well.